So we are finishing up chapter 4 today. Your homework is due tomorrow night for chapter 4. So don't forget about that. Today what we're going to do, we went through a lot of calculations last couple of class periods with figuring out that federal withholding, both using the wage bracket method and the percentage method. Today we're going to start out talking about some different types of information reports that the IRS uses to provide to individuals who receive certain types of income. So every year about this time, actually by the end of January, people are receiving these information reports. Individuals are receiving them so that they know how much income they received during the year in order to prepare their taxes. And we all know there are lots of different types of income. I mean, our focus in this class is wage income, but they're all different types of income that people receive. And so each of those types of income has its own information report. So I'm just going to kind of go through the list here and talk about some of these. We're also going to revisit a little bit that 941. Really, I'm just going to show you where the federal withholding for the quarter is entered on that 941 form. So remember, the the employer has to deposit any amounts that are withheld from employee paychecks. They have to follow that same deposit schedule that we talked about in Chapter 3. Remember the semi-weekly schedule or the monthly schedule, and it all depends on how much they owe in total. The federal income taxes that have been withheld from paychecks are included in the determination of how much has been withheld during the quarter. So that deposit schedule doesn't change, and the reporting schedule doesn't change. Everything that's been, that whole reporting requirement that we went through in Chapter 3 for Social Security and Medicare taxes, we're using the exact same form to report how much has been withheld for income taxes. We're using that very same form. So all it is entering that information then on that 941. So I'll show you a little bit about where that goes. We also want to talk about the W-2 form, which is an information form that individuals receive that reports all of their income from wages and withholding from those wages during the tax year. So an individual will receive this W-2 from every employer that they had during the year. So if you had 10 different jobs, 10 different employers, you'll receive 10 different W-2 forms that then have to be entered onto the information, then has to be entered onto the tax return that is filed every year. And that, by the way, that deadline is coming up. So if you had a tax return that you needed to file for this year, your deadline is April 15th. And so that is coming up quickly. Then I want to go through and talk about, so everything that we've done with regard to the calculations, the withholding calculations, was for those W-2 forms that have been issued in 2020 or later. So we want to talk a little bit about W-2 forms that are issued 2019 and earlier, because there are still a few of those floating around out there. I don't know when they're just going to put their foot down and say, you got to have a new W-2 or W-4 form. You have to, it has to be updated. They haven't done that yet, but because they haven't done that yet, we'll go through a little bit and talk about how that withholding is calculated using the information from the older W-4 forms. You'll see that the wage bracket method is pretty much the same. All we're doing is we're taking information from the W-4 and information about taxable pay and frequency of pay, and we're plugging it in to find it on the table. Okay, there are a couple of different inputs, though, that we discuss, or that we have with these pre-2020 W-4s and the calculations. The percentage method, it's very similar, but again, we're using different inputs, and there's one additional step that goes into the calculation when using the percentage method. I do have some time set aside. We'll see where we are at this point. I wanted to maybe practice some of those W-2 problems. I might have to go to my office. I don't know if you brought in the papers that I handed out on Monday, but kind of go through some of those, use them as an example for the 2019 and earlier W-4, if we've got time to do that. Then I want to take just really a quick look at Iowa withholding. And I printed off the Iowa W-4 form so that you can see it. It's also here. There's a link to it in the agenda, as well as information about how that calculation is done for Iowa. Iowa also has a table that can be used for calculating, for determining Iowa income tax withholding, but then they also have a formula that can be used. It is much more simplified than it has been in the past because, like I said, it's one tax rate and one tax rate only. And that's starting in 2025. But we're going to look at 2025. You don't have any homework problems related to Iowa withholding. This is just sort of FYI, an overview of how it's done. Okay, and that will get us to the end of the day. Any questions before we get started? Okay, so let's talk about, I'm going to kind of do a search of some of these just to give you some examples as we're going through them. So let's first look at the W-2 form. And I know your PowerPoint slides have examples of some of these, but I think it's best just to pull them up. So let's look at the W-2 form. It doesn't really matter what year. They haven't changed. Let's see what this one looks like. Now, let's get it from the IRS. There we go. A lot of you are probably already familiar with what these look like. And you've got examples of them in your textbook as well. So all of the information over here on the left-hand side is simply information about who is issued the W-2 form and who is receiving it. So at the very top, and by the way, these come in all different shapes and sizes. If you've had different jobs, you've probably noticed that when you receive your W-4. Sometimes you get them and they're half a page, like this one. This would be a half-page one. Sometimes there's 4 of them, and you get multiple copies of them, 4 of them on the same page. So you get they're in quarters of the page. Other times they'll use maybe a third of the page for each one. It doesn't really matter. There isn't really one particular format for it. I mean, there seems to be certain styles that are used, but what's important is that the information, regardless of how it's presented on that piece of paper, the information is all the same. So it's going to have information about who the employer is and what their address is. So this would be the issuer of the W-2 form. What their employer identification number is, so that EIN is going to be there. In addition, the employee's name, the employee's address, and this is important. A lot of employees, especially if they've left employment, will fail to update their address with a former employer or even with a current employer. And then this gets, if they're still mailing them, this can get lost in the mail or they never really receive it. So it's important for employees to make sure that employers have their current address if that address has changed. Now, a lot of these are issued electronically to employees these days. So, I mean, I know like DMAC, I don't get a paper copy of my W-2 form. I don't get anything mailed to me. I have a login that I use in order to access my W-2 form when it's ready. So that's a very popular way of issuing these. But if it is issued on paper, the due date for employees to receive these is by the end of January. Well, actually, the due date for employers to issue them is the last day of January. Or if that's not a business day, then the following business day. So if, January 31st falls on a Sunday, it has to be issued by February 1st. So they do have a little bit of leeway there, but they have the month of January to get these prepared. This is why January is such a busy month for payroll professionals. They are, not only is it the end of a quarter, so they're preparing those 941 forms and also any state forms that need to be issued. In addition, they've got to file these W-2 forms, and they may have to file other information forms as well. So we all hear about how busy tax season is for tax accountants, which is true. So usually from about February to mid-April is a really busy time for income tax accountants, those who are preparing those tax returns. Well, the real busy season for payroll accountants is the month of January. So it's pretty condensed, pretty intense, but it is only 1 month long. So these are issued, you can see over here, and we refer to these by their box number. So if you're in the profession, and somebody says, oh, well, what were the box 3 wages? You kind of know exactly what that means. So these box numbers here, so you can see box 1, box 2, 3, 4, 5, 6, 7, 8, and so on and so forth. So box 1, these are the wages that are subject to federal income taxes. So remember when we were doing that calculation on Monday, we were figuring out taxable income. We had some adjustments to that, right? 401k income was subtracted before we calculated the income taxes. Health insurance was subtracted. So what this box is the total for the entire year of what was taxable income for this one employee. Okay, so it might not be their total income because they have some pre-tax deductions from it, but it also may have some taxable fringe benefits that are added to it. So whatever was subject to federal income tax withholding for each employee for the entire year, January to December, that's what's going to be in box 1. Box 3, I'm going to go down this way instead of moving over. Box 3, that is the amount of Social Security income or income that was subject to Social Security tax. So remember, the retirement contributions, the 401ks, remember we talked about how they are pre-tax for federal income tax purposes, so they wouldn't be included in that box 1, but they are not pre-tax for Social Security and Medicare tax purposes. That means that the amount in box 3, if there were retirement contributions, retirement amounts contributed to the retirement account that were withheld from the employee's pay, there would be a difference between box 1 wages and box 3 wages. Because again, this is the total amount of wages for the year that was subject to Social Security taxes. Same thing for Medicare taxes. Also, if you recall from I'm going to have you try and remember from chapter 3 when we talked about that wage base for Social Security. Remember, only the first, does anybody remember the number? Only the first certain amount of income was subject to Social Security tax. I think it was 168.2, something like that, or 162.8. Maybe I'm getting it. Yes. So this is never going, the amount in this box is never going to be over whatever that Social Security wage base is during the year, because no more, none of the excess income would be subject to Social Security taxes. So it's entirely possible on these W-2s, and you see it a lot, that box 1 wages, box 3 wages, and box 5 wages are all different numbers. All 3 different. Because the amount of wage, again, this is the amount of wages that are subject to those taxes. Now you can see Social Security tips, if the individual had allocated tips or had reported their tips, that amount would be listed here in box 7 because those tips are subject to Social Security tax. Now over here on the right is we have the amount of tax that was withheld. Now this is only the employee's portion. This is not going to be any amount that the employer has paid. Federal income tax withheld, so the entire amount for the year that was withheld for this employee is listed in box 2. Box 4, Social Security taxes withheld. Remember, that's going to have a maximum amount as well. Since there's a maximum amount of Social Security wages that can be taxed, that means there's a maximum amount of tax that can be withheld as well. And Medicare tax withheld, same thing. For the entire year, how much Medicare tax was withheld. If there were any allocated tips, those would be listed in box 8 here. Dependent care benefits, if the employee had any amounts withheld from their paycheck for dependent care, that would be listed here. That amount would not have been included in box 1, 2, or 3. I'm sorry, 1, 3, or 5. So any amount here would not be there. This box 12 is for other types of deductions. They may be pre-tax deductions. They may be post-tax deductions. Usually they're pre-tax. So if an employee had retirement money withheld from their paycheck during the year, the total of that amount would be here with a code. The code determines or indicates what type of withholding it was. So code, let's see, I think it's code D is for retirement funds or 401k amounts that were withheld. Code DD is for health insurance that was withheld. Code W is for HSA contributions that were withheld. All of these pieces of information are necessary for the employee to then report on their income tax form, their 1040, when they file it. There are all sorts of codes. If there's more than 4, there may be an additional page to the W-2. Now down here below, and this, so if they're a statutory employee, or if they contributed to a retirement plan or had a retirement plan, or if the recipient of this W-2 has received it due to third-party sick pay, that means disability pay, private disability insurance pay, the appropriate box would be checked here. That's also important information to put on the 1040 when the employee is filling out their income tax form. Box 14, that's just for anything additional. A lot of times what you'll see in there is if there's like state disability payments, that would be in box 14. They may indicate the amount that the employer paid towards certain benefits, so they may or may not include that in there. That's just sort of supplemental information, may or may not be necessary for the employee's individual tax return. Down here at the bottom is all the state information. So if they're in a state where there's income tax, this part will be filled out as well. So if you're in Iowa, it would say IA, the employer's state ID number. So the employer would have their own state ID number, and because when they register as an employer in the state of Iowa, they are issued a state ID number. And that's what they attach to all of their withholding and all their reports. State wages, this should be the same as box 1, not always though, because there are certain states where maybe they have different rules for what is subject to income tax. State income tax that was withheld, right there in box 17. Now, if they're in a jurisdiction where there are income taxes at the local level, so we're talking, remember I mentioned to you I had a friend who lives in Ohio. They have all sorts of different types of local taxes, income taxes. They've got state income taxes, they've got city income taxes, they've got school district income taxes as well. So for her, this information gets really kind of tricky because she's got a lot of jurisdictions that have withheld income tax. If there are any local wages or local income tax, that information is listed there. In Iowa, you would never see 18, 19, or 20 filled out. It wouldn't be a part of an Iowa W-2 form. Okay? Questions about the W-2? All right. I'm sure most of you are probably pretty familiar with it. So W-3 form. Let's take a look at a W-3 form. Let's see if we can look at this. What the heck is a W-3? Sounds an awful lot like a W-2, but we got a different number. What the W-3 form does, employees don't see this. This is a form that's filled out by the employer, and it summarizes all of the information that was entered on the W-2s, all the numerical information. It's not going to list out all the individual employees. But what it does is it summarizes. So for all of the W-2s that were issued, all of that is totaled and entered into the appropriate box. You'll see that these boxes are pretty much the same, right? They're the same. So box 1, these are federal income tax wages. So for every employee for the year, the total of the wages that were subject to federal income tax would be entered there. this amount, when this form gets sent to Social Security and it gets sent to the IRS, along with copies of all of the W-2s that have been issued. So the IRS gets all of that information. This is why it makes it really hard to cheat on your taxes when you have income that is reported to the IRS, like W-2 income, because the IRS gets copies of everything. They know all that stuff. So if you had a W-2 job and you didn't report that income on your tax return, they will know. It may take them a little time to figure it out because they've got such a backlog, but eventually it catches up. So they have all that information. So everything here is summarized, kind of payer. So you can see 941. So if the employer if they had to file 941 forms and this income was related to the income that was reported on those 941s, they are a 941 payer. Now, remember, we talked about a couple of different types of forms. We had agricultural employees, and then we also had this, I think it was the 944, where they're not withholding. They don't have to file that 941 every quarter because they don't withhold very much. So they might be one of those. You can see there are some other types. I have no idea what a CT1 employer is or payer, but household employer. So if you had household employees, you would have to file this along with the W-2s, and you would click off that you're a household employee. Military has their own forms as well, or Medicare government. I guess employees of Medicare have their own as well. So that's what those boxes are up here. Most of these are going to be the 941. And then the kind of employer, if you're state or local, federal government, you have specific boxes. But if you're just an employer, a private employer, it would be none apply. None of those apply. You're just a private employer, right? So same thing down here is the state information. So again, this is just a summary of, I guess it's state ID number. I guess it's one line down. Wages, income tax, local income tax. All that stuff is reported to the IRS, reported to Social Security Administration on this Form W-3. Now, the important thing is all 4 quarters of those 941s, the total tax that was paid has to equal the amounts that are on here. And all of the W-2s totaled up together have to equal this. So all 3 of those have to reconcile exactly to the penny. If it doesn't, you have to fix it so that it does. So all 3 of those, and it's a way to essentially triple check that all of your information is correct as well. Okay? Any questions about the W-3 form? These are the 2 main ones that we're concerned about with payroll accounting, are the W-2 and the W-3, because they pertain to wages that were paid during the year. Okay. This out here. Now, that 941, let's look at the 941. I'll show you where this is entered. Let's look at the 2023. The instructions. Okay, so everybody's familiar with this. We all know how to fill this out, at least to include the Social Security income or Social Security taxes and income, right, for the quarter. Now, in addition to Social Security information that is entered down here, up here, sorry, not there, line 2 is wages, tips, and other compensation. This is going to be the amount during the quarter that you paid that were subject to federal income tax withholding. So you'll have 4 quarters of these. You add all 4 quarters up, this box 2, it has to equal what's in box 1 of that W-3 form to the penny, okay? And then federal income taxes that were withheld. Again, that box 3 has to, for those 4 quarters totaled up, has to equal what's on the W-3 form that's being submitted for the amount of federal income taxes that were withheld to the penny. So if all 4 quarters of these were $10,000, there should be $40,000 entered on that W-3 form. Okay? And then that's it as far as what gets entered onto the 941 for federal income taxes withheld. But remember, this then all gets combined with the Social Security and Medicare taxes that were withheld, and all of that is totaled up here for each quarter. Okay? Questions about how the 941 relates to those federal income taxes that were withheld? How we have to enter that information in. And again, the only thing that's different is that this is done on a quarterly basis. It has a different schedule for reporting. This is done on a quarterly basis. The W-2s and W-3 are done on an annual basis. Okay? Let's see. Okay, some of these other 1099s. Okay, 1099s are information returns. And you can see there's a whole list of these up here. I'm not going to pull up each and every one of these, but I'm going to give you kind of I'll pull up 1 or 2 to give you an example of what they look like. And maybe some of you have received these. If you've ever done any independent contract work, if you've ever been like a delivery driver for DoorDash, that's a popular thing to do these days. You know, a lot of times side hustle type money, what are some of the other types of jobs? That seems to be, I just finished up with the VITA program where we volunteered to prepare tax returns. We were over at United Way. It's a class, by the way, if you're ever interested in preparing tax returns and you're part of the specialist program, that's one of the electives that you can take. We have a great time. Actually, it's a fun class. We volunteer to prepare tax returns for individuals. And one of the most popular 1099s that we would get is what's called a 1099 NEC, non-employee compensation. These are independent contractors. We get a lot of people who would deliver for like DoorDash or, I don't know, some of the other delivery services. That is 1099 work. So that would be issued on what's called a 1099 NEC, non-employee compensation. But you can see there's all sorts of different, and this is not an exclusive list. There are lots of different types of 1099s. 1099 DIV reports dividend income during the year. These are annual totals. So if an individual had dividends from, maybe they own some stock in a corporation or in a mutual fund and they received dividends during the year, then they would receive a 1099 DIV. That is taxable income that has to be reported on their tax return. 1099 INT is for interest income. So if you have a bank account that earns more than $10 of interest during the year, I say $10 because there's a threshold above which they have to issue these reports. Under that amount, they don't have to issue them. You are still supposed to report the income, though. So if you got $5 from your checking account at Wells Fargo, they are not going to issue you a 1099, but on your tax return, you are supposed to enter the $5 of interest income, even though it wasn't issued. But so bank accounts usually, or certificates of deposit, savings account, anything that's earning interest income, that would be reported on a 1099 INT. 1099G, maybe some of you have seen these before if you've ever received a state refund or if you've ever had unemployment income. Those are the 1099, the G stands for government. So some payment from the government that you have received that is taxable. Like I said, if there's a state if you received a state refund for your taxes from last year, then you would receive this 1099G form that you then report. Sometimes it's taxable income, sometimes it's not, most times it's not, but just in case it is, they send it out to everybody. And then, like I said, unemployment income as well is reported on a 1099G. 1099 miscellaneous is just for some income that they really can't peg down one of the other categories. Like it's something, maybe you received a settlement from a lawsuit when the lawyer has to issue you a 1099. So that would be probably on a 1099 miscellaneous. So it's kind of a catch-all. 1099R is for retirement income. So individuals who are receiving, not Social Security income, that comes on a separate form, but retirement income from a pension or from an IRA distribution or a 401k distribution, that gets reported on what's called a 1099-R form. So let me real quick pull up an example. The 1099 NEC is a good one. So again, individuals receive these when they've had any type of non-employee compensation during the year, those independent contractors that we talked about. Now, there is a threshold for receiving these, and the threshold is $600. So if it's an amount, if an amount was paid that was under $600, the issuer is not required to send one of these out. The income is still reportable. You're still supposed to report it even if you if you got the income but didn't get the 1099, still the taxpayer's responsibility to report that income. But if it was under $600, they are not required to issue it. Now, a lot of places still will issue the 1099s rather than go through and divide up who we paid over $600 to and who we paid under $600 to. They just issue them to everybody. So non-employee compensation listed right there. Again, all of the information about the payer and the recipient over here. If there was any federal income tax withheld, usually there isn't, but sometimes there is on these, it would be listed here. And so the taxpayer would get credit for that tax that has already been paid. Same thing for the state. If there was any state income tax withheld, it would be listed here as well. Just like the W-2s, the format of this varies, right? It can be in all different types of formats, but the basic information, all of these boxes are going to be represented regardless of the format of that form. Let's look at a different form. Let's look at the INT form. So here's a 1099 INT, and it says right up there, interest income. So again, all the identifying information over here, who paid it, who's receiving it. Interest income is in box 1. Early withdrawal penalty, if you have a certificate of deposit, usually with certificates of deposit, you get a higher rate of interest, but you are required to keep your money in there for a certain period of time. So like you make a commitment to keep the money in that account for a year. If you withdraw it, they penalize you for it. If you received a penalty, it's listed on here because that is a deduction to you on your tax return. So that's what that early withdrawal penalty is. Interest, there are some different boxes for different types of interest. Tax exempt interest, specified private activity bond interest, interest on U.S. savings bonds, so like Series H bonds, Series I bonds, those types of things. The reason they have their own box is because they have their own tax treatment. Might be taxed differently between the state and the federal government, might be taxed at a different interest rate, that sort of thing. So that's why they're all separated there. There's all these other things too, bond premiums. That's getting a little bit into the weeds, but this is all, any information that pertains to interest income would then be issued on a 1099 INT form. Okay, that's all I'm going to go through as far as looking at the specific forms. They're the 8027. Let's pull up an 8027 real quick. Pertains to tip income. So this is the employer's annual information return of tip income and allocated tips. So if it's if they have individuals who receive tip income, the employer has to fill this out and file it on an annual basis. So again, I mean, the instructions are there and everything. I'm not going to get too far into that, just kind of an FYI. You don't need to know how to fill this out, but if you wanted to, it's all right there. So those are the different types of forms that we needed to take a look at. Are there any questions about any of those types of forms? That took a little bit longer than I was expecting. So, all right. let's start talking about pre-2020 W-4 form. First off, let's take a look at what it looks like. So we've got in our minds what the W-4 form looks like, the current W-4 form, right? It was a full page. The W-4 form from prior to 2020 was not a full page. This was it. Now, there were some boxes on here that you maybe wanted to do some extra calculations for, but this was it. It's not a full page like the new one is. And believe it or not, the new one is supposed to be simplified. Maybe it is, maybe it isn't. So the old W-4 form, again, name, address, all that jazz. Now you'll notice, remember we had filing status for the new W-4 form. Remember that married filing jointly, married filing separately. We had filing statuses. Here we don't have filing statuses. We have marital status. Are you married? Are you not married? That's it. So like that head of household status, if you're head of household, you would be listed as single. Here, there's no separate head of household. If you were, I think that's the big one. That's a difference that changes how income is withheld. But here it's just, are you single? Are you married? Or there's a third category. I'm married, but I want you to withhold like I'm single. Okay, the single withholding is going to be greater. So if, like, for example, if you checked off that you were married, did all the calculations, and the withholding was $200, but if you were single, it was $350, you can still, even if you're married, you could click that, yes, I'm married, but I want you to withhold at that higher single rate. Okay, so you can make that choice to do that. Not on this. Nope. That would just be married. You're either married or you're single. So it's marital status rather than filing status on this form. Now, this is a big difference here. Total number of allowances that you're claiming. That's a new concept. That's a new term. Allowances. What the heck are allowances? Well, on the second page of this sheet is a worksheet. Maybe not the second page, third page, where you determine what your allowances are. Now, allowances, there used to be, in the tax code, we had this additional deduction. It was called an exemption. And you received it, what it did was it reduced your taxable income. Every exemption that you had, you're nodding, so you remember this? Yeah. So every additional exemption that you had on your tax return, you received more of a deduction. And those exemptions were related to how many people you were claiming on your tax return. So for example, if let's say you're a family of four people equals 4 exemptions. And for each exemption, you would receive a deduction. I think when it ended, it was somewhere around $4,000 per exemption. So 4 times 4,000, you got this deduction of $16,000. So that reduces your taxable income. So if you're familiar at all with income taxes, you'll know that there is a standard deduction. There still was a standard deduction, but then in addition, there was this exemption. These exemptions related to the allowances. So in theory, this calculation was supposed to take into account that you were going to get an additional deduction. So the more allowances you had, the lower your federal withholding. So as the allowances go up, federal withholding goes down. So here is the worksheet. So you would get to enter 1 for yourself, 1 if you're going to file as married filing jointly, 1 if you're going to file as head of household. So there, it's not exactly, here it was per person that you had on your tax return. Here it's a little bit different. You can get some additional allowances related to certain other tax benefits on the tax return. Head of household, because head of household has different tax rates. They're kind of somewhere in the middle between single and married. Also, they have a different standard deduction, which is right smack dab in the middle of what the deduction is for single and married. Married filing jointly, I should say. Enter 1 if you're single, married filing separately, have only one job, or married filing jointly, have only one job, your spouse doesn't work, yada, yada, yada. Child tax credit, if you're going to take a child tax credit, you're going to get allowances for that. Well, guess what? Because you've got this here, taking into account the child tax credit, it's a different calculation than, remember we were removing that child tax credit at the end of our calculation for withholding. So it kind of changes that a bit. So child tax credit for other dependents, you'd get additional allowances, other types of credits that you're planning on taking. Also, if you're planning on itemizing, you would do this additional worksheet that could get you additional allowances. So anything that was going to end up as a credit or a deduction on your income tax form would relate to the number of allowances that you're claiming on your W-2 form. Because those deductions and credits, the more deductions and credits you have, the lower your taxes. The higher the number of allowances you have, the lower your taxes. So it all related to the federal income tax form and the different deductions and credits that were allowed. Well, the reason this all changed is because in 2017, there was a big change to the tax law, and a lot of those deductions and credits were changed, as well as those exemptions went away. Now, what they did instead was they increased the standard deduction. So the standard deduction was maybe for married filing jointly, I think it was about $12,000. When that changed, they did away with the exemptions, but they doubled the standard deduction. So then it became $24,000 for the standard deduction. So they still got, taxpayers still received roughly the same tax benefit. It would have been on an individual level. The more kids you had, the less your benefit was. Because now you're not getting to increase your deduction with these exemptions. You're just kind of getting that additional standard deduction. That's it. So it benefited certain taxpayers more than it benefited others. But because of that change, they had to change how all of this was done. Because now we don't have these allowances anymore. When we went through that whole calculation, there was nothing about allowances, right? We had those 4 factors that we needed: filing status, frequency of pay, taxable income, and checkbox, right? There's no mention of allowances in that. Well, when we're doing a return that has, or not a return, when we have an employee who has an older W-4, we still have those allowances in play. So instead of that checkbox, the allowances are in its place. Or well, I should say the checkbox, I'm trying to think, it was the checkbox that replaced the allowances. It's not a direct link. But if you recall, we had those 4 factors at a minimum that we needed to know in order to calculate the taxes. Well, we still have at a minimum 4 factors, but 2 of them are different with the pre-2019. So pre-2020, 2019 and earlier. We still need to know taxable income. Now I'll just put this up here. So post 2019. We also need to know taxable income. So we still need to know that same piece of information. We also, frequency of pay. We still need to know that. How frequently is the individual paid? Remember, we also needed to know checkbox. And I'm drawing a blank. Why can't I think of this? Oh, filing status. So this is what we need post 2019. These two are different over here. Now we need to know allowances, and instead of filing status, it's marital status. So these are the two things. We still need these two pieces of information, but now instead of checkbox, there's no checkbox on here. If you look at the W-4, there's no checkbox anywhere. I mean, there are boxes that you check, but there's no checkbox. And there's no filing status. Now it's just marital status. So those are the 4 pieces of information that we need in order to calculate the withholding. Yeah.
Is there a reason why you do
Yeah, I explained that earlier because they changed the tax code. And so we didn't have any exemptions anymore. And so now because we don't have any exemptions, we really have no need for these allowances. Yeah. And I think the marital status helps to tailor the withholding more to individuals' personal situations, right? I mean, up here you've got 2 choices. With filing status, you've got multiple choices with that. And it's a little bit more tailored to the individual. So, and I've got that on here. So these are the 4 pieces of information. We still have a wage bracket method, and we still have a percentage method. So, and you would find these, maybe I can just click on it through here, in the Pub 15. Same publication. So remember we looked at these wage bracket tables 2020 or later, percentage tables for 2020 or later. Well, we've also got wage bracket tables for 2019 or earlier and percentage method for 2019 or earlier. So let's look at the wage bracket method for 2019 or earlier. I said, let's look at, wow, okay, page 27. It's probably not exact on here because it's there we go. All right, so here's our worksheet. Remember the worksheet that we had before? We had a lot of lines on it. This is our worksheet now, essentially. So enter the employee's total taxable wages this pay period. Use the amount on line 1A to look up the tentative amount to withhold in the appropriate wage bracket table. Okay, that's pretty simple. We've only got 4 lines. So let's look at the tables. Now you'll see this is where we need that marital the frequency of pay, because again, we're going to look for the correct table. So let's have a little fun here. I'm going to erase this. That was just a reminder. So let's say we have, do it in red, let's see how that does. Taxable income is $2,000. Frequency of pay is biweekly. Allowances, let's say they have 3 allowances. And marital status is married. All right, so the first thing we're going to do is find the appropriate table. They are paid biweekly. So this is the weekly payroll period. You're going to see this is set up a little bit differently because you see right up at the top it says married. We have separate tables for married and single. So it's on a completely separate table. So let's find biweekly. Biweekly. All right. Biweekly married. So we're going to need the biweekly married table. Same thing here. We're going to look at the taxable income. Again, biweekly married. All right. We need our range over here. So it's $2,000. So this is the table that we're going to use. So it's going to, all right. So this is the table here. 2000 is between 1970 and 2020. So now what we have to do, we've already got the marital status. We've already got the frequency of pay. We've already got the taxable income. Now we take the allowances, which are listed up here. Now you'll see these stop at 10. People can have more than 10 allowances. If they do, though, that means this is off table. We're going to have to use the percentage method. So if their income doesn't fall on the table or their allowances don't fall on the table, we have to use the percentage method. So in this case, it's fine. It falls on the table. So $2,000 and here, so 0, and you can see how this works with the more the allowances, the less the tax. If you claim 0 allowances, which a lot of people did, they would claim 0 just because they wanted the maximum amount of withholding. They wanted their big refund, so they would claim 0 allowances, even if they had 14 kids. They claim 0 allowances. That's fine. The IRS doesn't mind if you have too much withheld. They do mind if you don't have enough withheld. They start to get persnickety about that. So, but the column up here that corresponds with the number of allowances that you have claimed, so we're in this column here, you find the income level, which is right here. So here would be $95. I should just pull up the 15T so I don't have to keep doing that. And that, by the way, I think that's the 2023 that's in the link to it is the 2023 one. Let's see. I want 2023. There we go. Okay, just easier to use if it's like this. So again, let's do one more. This is pretty simple. So give me an income level. Give me taxable income. Just throw a number out. 7,000. Okay. We may have to, we're wanting to stay on the table here, so we'll see if this works. We need like probably a monthly. Let's just say it's monthly. How many allowances? Don't go off the table. 2. Marital status? Single. All right, let's take a look. So we're going to find the wage bracket method. If there was, by the way, so that would have been our 1B. If there was an additional amount to withhold, that's where we would enter it in. But you notice there's no like the child tax credit or do you have any additional income or anything like that. So that's why it didn't really simplify things to move to this new W-4, but it made it more precise, right? It gave people, because more information is needed in order to do the calculation, it made it closer to what the taxes that they were actually going to owe, if they filled it out properly. If they didn't fill it out properly, it's a whole different story. Garbage in, garbage out. Okay, so we want to find the monthly table. Scroll quite a ways. Let's see. Biweekly. You can see there's a lot more tables here. Semi-monthly, semi-monthly, monthly. Okay, monthly married. So we don't want this table because this is only for married persons. We want the single one. The first table is married, next table is single in the order. So, really? All right. Monthly, single. Do we stay on the table? Yes, we do. Okay, good job. All right, so income is $7,000 between $69.90 and $70.70. They are claiming 2 allowances, so we scroll over, $902. Okay. Is the amount of withholding for the month. That's not so bad, is it? All right, So let's find out what happens, though, if we have too many allowances, or we have more allowances that are on the table. I shouldn't say too many. We have more allowances, or claiming more allowances than what are on the table, or if our income doesn't fall on the table. So in that case, we are going to use, where is it here? The percentage method. We'll go back up here to the table of contents, and we will find the percentage method tables for manual payroll systems, forms W-4 from 2019 or earlier. All right, now it gets a little bit trickier. We do have to do a little bit more calculation. This looks a little more familiar. Still not quite as many steps to it as there was before with the new system, but still. All right, so here we've got to enter the employee's total taxable wages this pay period. So again, let's find, give me taxable income. Still need these pieces of information. So taxable income. And you can go higher this time. Anything you want. 10,000. How frequent? Semi-monthly. That's a nice, healthy wage. How many allowances? 50. Holy.
15.
Oh, 15. Okay. I don't know if 50 is going to. And marital status? Married. Of course they're married. That's an attractive salary level. So, all right. So step 1A, enter the employee's total taxable wages for this payroll period. All right. So we've got that. I want to make sure I can get this in here. So let's do the calculation. So 1A is $10,000. All right. 1B, enter the number of allowances claimed on their W-4, 15. Multiply line 1B by the amount in table 7 corresponding to your pay frequency. So how much is that? So 15 times, what number would we use? 179. Now we've got to do a little bit of math here. 2685? All right. This is, so last one. Subtract line 1C from line 1A. So we're going to take 10,000 minus 2685. Let's see if I can do this in my head. So 7,315.
Yeah.
That's our adjusted wage amount. Okay. Now, figure the tentative amount. So this is our adjusted wage amount. That's 7,315. You can see where these, now this is what we're going to base our tax on. The higher this number is, the less our taxable income is going to be, right? So that means the less our tax is. All right. Now, this will look familiar to you. Find the tentative withholding amount. I'm not going to use this. I'm going to go to the table. These look familiar? Same tables, exactly. But you got to make sure you got the right one. So semi-monthly, married and single. This is a little simpler because we don't have that, like we had that checkbox on, was it the table on the left or the table on the right? Here, it's just, are you married, are you single? That's what's going to determine which table we use. Same method. All right, so find, they're married and they're paid semi-monthly. Find the adjusted wage amount, or the range for the adjusted wage amount, which would be here 43.44 to 85.65. Right? Tentative amount, 428.92. So we're going to do the same thing. We're just going to write that down, set it aside, 428.92. Set that aside for now. Plus 22% of the amount over 43.44. So again, we're going to just subtract 43.44 from here, and then we're going to multiply our result by that percentage. So 7315 minus 2971 times 22%. $653.62. We're going to add that here. So 653.62. Add those two together. You guys can probably do this faster than I can. But 8, 11, what? I can't think. 2, 8, 10. 1,082.54. This is the exact same procedure that we did before. The difference in this is this step right here. These two things, right? The allowances, and I will tell you, I think you do have problems in your homework if you haven't already done your homework. I'm sure most of you are almost done. There are problems in there that ask you to do the calculations, these older calculations, or the calculations for the older W-4 forms, and probably one of the most common mistakes I see students making is they forget this step. You know, we've gone over and over and over the percentage method for 2020 and later that doesn't involve these allowances, but they forget this step of subtracting those allowances. All right. What do we got here? 156. Let's do one more. Are there questions about this one? Oh, you want to? You're welcome. Oh, this marker is not good. All right, let's do one more. I get my upper body workout getting these off of here. All right, taxable income, give me a number. $5,000. Frequency. Biweekly. E. Allowances. Marital status. Single or married? Single. All right. Now, chances are there's a possibility that this would actually be on the table, but that's okay. We can always use the percentage method, even if it falls on the table. Like, even if we can use the table, we're always allowed to use the percentage method if we want. It's more accurate, gets us down to the dollar, to the penny, really. But make sure in your homework that you use, if it indicates which method to use the right method that they're talking about. Okay, so let's start this again. So taxable income, and again, remember, you would still, if there are some pre-tax benefits that have been paid, and it hasn't been subtracted from this, you'd have to subtract it, right? The same thing that we did on Monday. We'd still, in order to arrive at the correct taxable income, you might have to make some adjustments. So keep that in mind as well. All right, wages, taxable wages withheld, I'm sorry. Enter the employee's total taxable wages, sorry. So 1A, 5,000. B, number of allowances. 2, C, multiply the number of allowances by the correct number in the table. So 2 times what number? What number up there are we going to use? 165, right, because it's based on the frequency of pay. So 2 times 165, which equals what, 330? Did I have that right, 330? And D, we're going to take 5,000 minus this 330, okay, to get $4,670. All right, there's our adjusted wage amount. Next, what are we going to do? Yeah, so we have to find the correct rate, find the correct table. So based on frequency of pay, we got to find the right table. So that was weekly. Monthly, sorry. It's all on the same one here. So we are biweekly, so we're going to use this table, and we are single, so we're going to go over here. All right. So our adjusted wage amount, which is right there, $46.70, falls between $38.70 and $72.06. So here is the row we're going to use. Stop. All right, so our tentative amount to withhold here is $626.50. Let's write that down here. And then we're going to withhold 24% of the amount over $38.70. So let's subtract that. $38.70. 0, 0, 800. 800 times that percentage. 24%. How much? 191?
192, sorry.
I was going to say, I think it'd be an even number. 192. Going to add 192. $818.50. Okay, remember to reference this because you've got all the steps right there. This, what we just did, the second part of that, on the table, if you forget how to find it on the table, that's what these steps are, right here. And then there's an additional amount to withhold here. So you can see there's nothing about additional child tax credit or anything like that. All of that has presumably been taken into account with the allowances, but it didn't do a very good job of taking it into account. Now it does a better job of taking that into account. All right, 2 o'clock. Any questions? All right, I want to now take a look at Iowa. And I've got something for you. More handouts. I know you guys like your worksheets. It's not really a worksheet. It's just the Iowa information. And this is for 2025. So this is current. Okay? You bet. Hopefully I have enough. 1, 2, 3, 4. Okay. I'll have to look at the forms on. I'll hold them up. Okay. You're welcome. One of these forms is the Iowa W-4 form, which, conveniently enough, I just had to fill out a new one because I did my taxes and it wasn't good. And didn't want that to happen again next year, so there you go. You're welcome. Pull these up.
I remember I was telling you, I had the papers you gave us last time on my computer, and my sister's like, "What is this for?" She's like, "You have to fill it out." I'm like, "Oh no, it's for class." And she's like, "Oh, okay."
So let's take a look at the Iowa W-4 form first. So with the Iowa W-4 form, we do have a head of household. We have different filing statuses. So we've got single, head of household, married filing jointly, or qualifying surviving spouse. Now, we don't have married filing separately. I believe, other. So that's the filing status. If you're married filing separately is the other category. If so, what? Let's see. Does your spouse also have earned income? All right, so if you're married filing jointly, if your spouse works, has earned income. Earned income is anything that's going to be subject to Social Security tax. So wages, partnership income, self-employment income, anything like that. Things like dividend income, interest income, that is passive income. It is not earned income. So did you work for your income, or did your assets work for your income? Did you do the work, or did your money that's sitting in another account do the work to earn that income? Sort of thing. So also have earned income, yes. And then, of course, all of your information about your name, your social security, all of that stuff. Now, there's a spot here. If you do not expect to owe any income tax, and you have a right to a refund of all income tax withheld, enter exempt here. So if you're one of those people that doesn't, and a lot of times this will maybe pertain to kids who have summer jobs, you know, they don't earn enough to then have to pay tax. Although in Iowa, the amount you have to earn to pay tax is a lot higher. A lot lower than the amount on at the federal level. Off the top of my head, well, actually nowadays it'd be about the same because they use the same standard deduction. We didn't used to use, that's a recent development. So it actually might be roughly the same. Now, it didn't used to be, the standard deduction in Iowa used to be really low, like $2,000. And now they use the federal standard deduction. So it would be something like, if you're single, $12,000. So that means it will be less taxable income. So if you're not going to owe any tax, enter exempt here. And what this does is they're not going to withhold anything. And that means that chances are you're not even going to have to file a tax return. So at least you don't have to pay somebody else to file the tax return, right? Now, it doesn't mean 100% that you're not going to have to file, because even if you don't owe tax, sometimes you still have to file. But it helps those individuals to not have to file a tax return, and nothing will be withheld. As it says here, non-residents cannot claim that exemption. So if you're a non-resident with Iowa and you're filling this out, you still are going to have to fill out the rest of it and probably have something withheld. Okay. Iowa still has these personal allowances. They don't do it in like single numbers like the federal government used to. They do it in dollar amounts. So personal allowances, and there's a separate worksheet, I think, down here. Here you go. That's for itemized deductions. I thought there was a separate worksheet. I wanted to go through this too with you guys. Maybe there isn't. Personal allowances, that's usually just you. Hold on a second. They've changed some things, and so this is kind of still new to me as well. 64. No, I don't want that. Okay, you can claim the following personal allowances. So $40 for yourself, or $80 allowance if you're unmarried and head of household. Add $20 additional allowance if you are 65 or older, and $20 if you are blind. So that's what your personal allowances are. So for most people, it may be 40 or 80 if you're claiming head of household status. So that's your one personal allowance. Allowance for dependent, you can claim $40 for each dependent you claim on your income tax return. So these are kind of like Iowa's exemptions, and you see them on the tax return as well, but they're so low. It really doesn't make a whole lot of difference to your tax, especially since now we have a tax rate of 3.8%. So for each additional one of these exemptions, you're going to get 3.8% reduction in your taxes. That's not a whole lot of money. 3.8% of $40, that ain't very much. So you add all these allowances for itemized deductions. There's a separate worksheet for that. Down here, we just passed it. There it is. So you can fill that out if you itemize your deductions. Most people don't, but if you do, you can have a separate worksheet for that and claim allowances for itemized deductions. Other types of income as well. Allowances for child dependent care credit. This is at the state level, not the federal level. There are different requirements that you have to meet in order to get those credits in Iowa than you do at the federal level. So you'd have to know that you're eligible for them at the state level. And then you total all of them here. So if you are, let's say you're single, head of household, and you have 2 kids, 80 for yourself because you get that allowance for yourself, and then another $80 for your kids, $40 times 2. So you'd have a total number of allowances of $160. All right. How do those all play in? So that's the withholding. That's the W-4. Actually, so stick a pin in that $160. I want to go down here while this is still open and show you. Remember we talked about early in the class about how employers have to notify the state upon a new hire when they get a new hire in, and that's in order to check the child support database, which is a federal requirement. This form has to be filled out. It's usually filled out by the employer. The employee doesn't have to necessarily do anything, but it has to be filled out. This is the form that gets sent into the state. It also indicates if there's any garnishments that they know about at this point. So also employers will be notified if there are garnishments based on the information that was filed here. So, and then they've got the phone number, fax. Do people still use faxes? Fax. There's not even an email, or you can mail it in. All right, so we've got our $160 of allowances. Now we'll go over to the instructions. There are tables, and there are they have tables that you can use as well as a percentage method. So the tables are there. I'm not going to show you that because you can look up this. You know how to look up this stuff on tables. You've done that a couple of times now. At the federal level, it's the same at the state level. So let's look at the formula, which this is what you have. All right, so this takes you through step by step. Step 1, determine, and they've got these abbreviated, like, they're not even acronyms. They're just like, I don't know why they think it makes it easier to use these letters and numbers to replace what they actually are. But T1, we've got to figure out what T1 is. T1 equals G minus D. Well, what the heck is G minus D? G is our gross taxable wages for the pay period. D is the deduction for the pay period. So to determine T1, identify the gross taxable wages, which would be the same as what we did for the federal, right? Subtract the appropriate deduction amount. So use step 1A for employees who have filed a 2024 or 2025 W-4. Use step 1B for employees who have a W-4 from 2023 or earlier. So you can see Iowa as well has changed their W-4. It changed, though, in 2023. Let's assume we have a 2024 or 2025. So identify the gross taxable wages for the pay period, subtract the appropriate deduction shown below based on the marital status. All right. So let's just say we have taxable wages of $3,000, and let's say we said had a household, right? And we had 160 in allowances. We'll need to know how, and biweekly. All right. So biweekly, head of household, we're going to subtract this number. So $694.23. This is our deduction amount. $23,0577. Okay. So that's our T1. We figured out our T1. Now step 2. This is for people who had 2023 or earlier, so we're not going to look at that right now. Step 2, determine T2. T2 is T1, so this is T1. T1 times 3.8%. So T1 times 0.38, and this is T2. All right, so 2305. There's our 3.8. That's our tax rate. 87.62. All right. T3. We're going to take T2, which there's T2, minus W divided by P. All right, what the heck is W? What the heck is P? So divide the total allowance amount by the number of pay periods per year. So this is our P here. We are biweekly, so our P is 26. And our W is our allowance amount. That was that $160. So we're going to take 160 divided by 26, and we're going to take T2, which is 87.62, minus that amount. So $6.15. So 87.62 minus 6.15. There's our withholding. Okay, that's how Iowa does it. Any questions? Like I said, I'm not going to go through that in more. Now, if there was additional withholding requests, so that's the last step here. If they said, hey, withhold an additional 25 bucks, we're going to slap another 25 bucks on that. That's the last step there. Questions? Okay. I know that's a lot to get through. This is a big chapter.